Imagine investing your life savings into a company that Wall Street called the future of America. A company praised by analysts, loved by politicians, and trusted by thousands of employees. On paper, it looked unstoppable. Its stock price kept climbing. Its profits looked incredible. Its CEO was treated like a business genius. But behind the scenes, almost everything was a lie. For 16 years, Enron managed to fool investors, banks, regulators, journalists, and almost everyone else. By the time the truth finally came out, when over $63 billion had disappeared, thousands lost their jobs, millions lost their retirement savings, and one of the biggest corporate frauds in history had changed the business world forever. So, how did nobody catch it for 16 years? Let's find out. Our story begins in 1985. Two energy companies merged to create a new business called Enron. At first, it was just another pipeline company transporting natural gas across America. Nothing exciting. But then a new CEO, Kenneth Lay, had a much bigger vision. Instead of simply transporting energy, why not create a marketplace where companies could buy and sell energy like stocks? It sounded revolutionary. And for a while, unless it actually worked, Enron rapidly expanded into electricity, broadband, water, and even weather derivatives. Investors loved the ambition. The media loved the story, and Wall Street couldn't get enough. Enron wasn't selling gas anymore. It was selling a dream. As Enron expanded, investors expected one thing every quarter: higher profits. Missing expectations wasn't an option because, on Wall Street, growth isn't rewarded. Continuous growth is. So Enron found a clever solution. Instead of recording profits only after actually earning them, it started estimating profits from future contracts. This accounting method is called mark-to-market accounting. Imagine signing a 10-year contract today. Instead of waiting 10 years to earn the money, you immediately claim all the expected profits as today's income, even if that money never arrives. Legally, the method wasn't always illegal, but Enron stretched it far beyond reality. Suddenly, projects that hadn't made a single dollar looked massively profitable. Quarter after quarter, the company looked healthier than ever, but those profits mostly existed on paper. Eventually, reality caught up. Many of Enron's investments started losing money. If investors discovered the losses, the stock price could collapse. So Enron's executives created something incredibly complicated. Hundreds of hidden companies called special purpose entities, or SPEs. These companies secretly took Enron's debt off its balance sheet. Imagine moving your credit card debt into your friend's name, then telling everyone you're debt-free. That's essentially what Enron did. On paper, the company looked financially strong. In reality, it owed billions. The mastermind behind many of these structures was CFO Andrew Fastow. Even worse, he personally made millions managing some of these entities. It was a massive conflict of interest. Yet almost nobody questioned it. Why didn't anyone stop it? This is the most shocking part. The warning signs were everywhere, but almost everyone benefited from believing the story. Investment banks earned huge fees. Analysts kept giving Enron buy ratings. Executives became incredibly wealthy as the stock price soared. Even Enron's auditor, Arthur Andersen, approved the financial statements year after year. Employees believed the company was unstoppable. Many invested their retirement savings almost entirely in Enron stock. The higher the stock climbed, the more people ignored the risks. Because sometimes, the biggest bubble isn't built on numbers, it's built on belief. Everything began falling apart in 2001. A few journalists and skeptical analysts started asking difficult questions. Then internal documents began surfacing. People wanted answers. Where was all the cash? Why were the financial statements so confusing? And why were billions of dollars hidden inside mysterious partnerships? Once confidence disappeared, everything happened incredibly fast. Investors rushed to sell. Banks stopped trusting Enron. The stock price collapsed from around $90 to less than $1. One of America's biggest companies had become almost worthless in just weeks. In December 2001, Enron officially filed for bankruptcy. At the time, it was the largest corporate bankruptcy in U.S. history. The damage was devastating. Thousands of employees lost their jobs. Many also lost their life savings because their retirement accounts were heavily invested in Enron stock. Executives who had sold their shares earlier walked away with millions. Ordinary employees were left with almost nothing. Arthur Andersen, one of the world's largest accounting firms, collapsed after being found guilty of obstructing justice by shredding audit documents related to Enron. Although that conviction was later overturned, the firm's reputation was destroyed, and it never recovered. The scandal also led to the Sarbanes-Oxley Act, one of the biggest corporate governance reforms in American history. Companies now faced much stricter financial reporting rules because Enron proved something terrifying. A billion-dollar company can look perfectly healthy while secretly collapsing from the inside. Enron wasn't just a business failure, it was a failure of trust. Investors trusted executives, employees trusted leadership, auditors trusted the numbers, and Wall Street trusted the story. But when everyone stops asking difficult questions, even the biggest lie can survive for years. That's why the Enron scandal is still taught in business schools today, not because it was the biggest fraud, but because it showed how easily intelligence can be replaced by blind optimism. And perhaps the most dangerous lesson is this: companies rarely collapse overnight. They usually collapse long after people stop questioning them, because the most expensive lies are often the ones everyone wants to believe. And if you think Enron was the last company to build a billion-dollar empire on an irresistible story, think again. Nearly 2 decades later, another startup convinced investors that it wasn't just renting office space. It was reinventing the future of work. Its valuation exploded to $47 billion before reality came crashing down. That's the story of WeWork. Click on that video next, because once you see the similarities between Enron and WeWork, you'll never look at billion-dollar companies the same way again.